Chapter 7, Long-Term Assets. We will continue on learning Objective 4 today with calculating depreciation of property, plant, and equipment. In the previous videos, we discussed the straight line method, as well as how to calculate depreciation for a partial year and a change in depreciation method estimate. We will move on today with the next method of depreciation, the declining balance method. The declining balance method is an accelerated depreciation method. Declining balance depreciation will be higher than straight line depreciation in the earlier years, but lower in later years. However, it is important to note that with both declining balance and straight line method, you take the same total depreciation over the asset's service life. The depreciation rate which we use under declining balance is a multiple of the straight line method. The most commonly used is the 200%, also called double declining balance method, since the rate is double the straight line method. A simple way to get the depreciation rate for double declining balance is to divide the number 2 by the estimated service life. In our previous example of our 5-year asset, we had a depreciation rate of 20%. If you take 2 and divide it by 5, you get 40%, which you see is double the straight line method. Two things to notice with declining balance depreciation. We multiply, and you'll see this in the next page on the depreciation schedule, but multiply the rate by the book value of the asset, not your asset cost. And also, because we're taking a higher amount of depreciation in earlier years, it may not take the entire estimated service life to depreciate to residual value. Again, with this method, you've got to make sure that you're not depreciating lower than the residual value. So here's the example of Little King sandwiches. And you'll notice that your depreciation schedule is set up a little bit differently. We have a book value of $40,000. That is how much we paid for the asset. So in year 1, our beginning book value does equal our cost. $40,000 times our depreciation rate, which is double the straight line rate. Remember, 2 divided by 5 years is 40%. Tells us that in the first year, we're taking $16,000 of depreciation. Our depreciation, accumulated depreciation at the end of the year, is equal to our previous accumulated depreciation, which is 0, plus the current year depreciation expense of $16,000, which means we have an end of the year book value of $24,000. To start year 2, we bring the ending book value from the previous year down as our beginning book value. That $24,000 is then what we want to take 40% depreciation on. Not the cost, but the book value. $24,000 times 40% equals $9,600. Our accumulated depreciation will be our previous accumulated depreciation plus this year's depreciation expense, or $25,600. Our book value is now $14,400. Our original cost minus our accumulated depreciation of $14,400. Pull the $14,400 down as your beginning book value. Take 40% of the beginning book value. Depreciation is $5,760. To end up with accumulated depreciation of $31,360, book value of $8,640. Pull the $8,640 down to line 4, year 4. Take 40%. $3,456. Accumulated depreciation is the prior year plus the depreciation expense to get a book value of $5,184 at the end of year 4. If you notice, don't forget, we're taking the beginning book values, multiplying it times the depreciation rate to get depreciation expense. And as you see, depreciation expense is declining each year. Now, year 5. Year 5, our beginning book value is $5,184. If we took 40% of that, then we would have an accumulated depreciation of more than $35,000, and our book value would go below residual value. So for year 5, we only take the amount of depreciation needed to get our residual book value down to the residual value of $5,000. So you've got to keep an eye on your book value as you're going along to make sure that you don't go below residual value. So we see in year 4, we're at $5,184. If we took 40% of that number, it would be way too much and we would be below residual value. So we simply plug for depreciation expense in year 5 for $184 to make our book value equal to residual value. The third type of depreciation is activity-based depreciation. Straight line and declining balance methods measure depreciation based on the passage of time. In activity-based, we instead allocate an asset's cost based on its use. For example, we can measure the service life of a machine in terms of the number of units produced. This also works for vehicles when we measure in miles. The first thing we need to determine is the depreciation rate per unit, which we calculate by dividing the depreciable cost by the number of units expected to be produced, or in this example, the number of miles expected to be driven. So our depreciable cost, which remember is cost minus residual value, divided by units expected to be produced. In this example, our cost is $40,000, our residual value is $5,000, and we expect to drive 100,000 miles. So our depreciation rate is 35 cents per mile. From there, we can prepare a depreciation schedule based on actual miles driven. So in year 1, the vehicle was driven a total of 30,000 miles. We want to depreciate the vehicle at a rate of 35 cents per mile driven. So in year 1, we would take $10,500. Our book value was our cost minus our accumulated depreciation gives us a new book value. In year 2, we drove 22,000 miles. So we depreciate those 22,000 miles at 35 cents a mile, $7,700. Accumulated depreciation is the prior year accumulated depreciation plus this year's depreciation expense. We continue this on, multiplying actual miles driven times our rate for each year. Now notice, in this example, the delivery truck is driven exactly 100,000 miles over 5 years. What if we drive the delivery truck less than 100,000 miles by the end of the 5th year? We will then continue to depreciate the truck past 5 years until we reach 100,000 miles. Similarly, if we drive the delivery truck more than 100,000 miles by the end of the 5th year, we will stop depreciating the truck at 100,000 miles before the 5 years are up. In either case, we need to depreciate the asset until the book value declines to residual value. So whether it takes you 4 years or it takes you 7 years, the years are irrelevant. We're worried about miles driven. So we want to depreciate the vehicle until actual miles equals the estimated number of miles driven. So here's a comparison of the 3 depreciation methods that we talked about. Remember, in straight line depreciation, we took $7,000 per year for 5 years for a total of $35,000 worth of depreciation. In double declining balance, we started out with a higher depreciation of $16,000 in year 1, and by year 5, we only took $184. When we add all those up, we still took $35,000 worth of depreciation. And then with activity-based, remember with activity-based, it's based on actual number of miles driven times your depreciable rate. So we took $10,500 in the first year, $77,000 in the second, and so on. But overall, we still took $35,000 worth of depreciation. So in the end, total depreciation is the same under each method. Here is a chart to show you how the green is straight line. Depreciation remains flat, remains the same throughout the entire useful life. Double declining starts high and then decreases each year until it is done. And activity-based can be kind of all over the place. It could be high and then low and then high again, because it's based on the actual number of miles driven. If you look at a breakout, you'll see that 92% of U.S. companies use straight line method over declining balance, activity-based, or other. It's the most popular method used. So why do so many companies use the straight line method? Many probably believe they realize benefits from the plant assets approximately evenly over the asset service lives. One motivating factor has certainly got to be that straight line is the easiest method to apply. Lastly, tax depreciation. Conflicting with the desire to report a higher net income for the financial statements for investors is the desire to reduce taxes by reducing taxable income. As a result, most companies use the straight line method for financial reporting and an accelerated method called MAKERS for tax reporting. MAKERS combines declining balance methods in earlier years with straight line in later years to allow for a more advantageous tax depreciation deduction. So companies are allowed to take straight line for financial and an accelerated for tax reporting, but they have to keep pretty much two sets of books in doing so.